Okay, so good morning, my dear future chartered accountants. Hope everybody is doing great. First of all, can you please confirm that my voice is audible and the PPT is visible? Okay, yes, thank you. So we are in an important juncture now, that is derivatives. Many people say this chapter is not for weak-hearted people. I mean, we say no that warning signs on TV like pregnant women and children should be away from this, something like this. So derivatives is definitely a lot of areas involved. Some complex areas are also involved. But if you understand in a systematic manner, step by step, I'm sure you'll be able to master this concept. But this is actually definitely easy in examination perspective. Practically it is even more difficult. So let's just discuss more about examination point of view. Practical operations here and there, definitely I will discuss as well. Okay, so derivatives. So as the name suggests, it is a dependent variable. Means there is already something there, and based on which you construct something above that. Derivative means dependent, or that is called as underlying variable. There is something basics and something dependent. Something basics is called as underlying asset, underlying variable, and something dependent is called as derivative. Some more aspects are there, but before that, uh, let's understand some basics of it. Derivative, even though I don't really agree, it is not a betting, but many people somehow use derivative only for betting purpose, like a speculation purpose. So that example I'll give, but don't take it to your mind that derivative means betting, but most people use it like that. Okay. Now there is a cricket match. One person bets Sachin will score a century. Other person obviously says opposite, Sachin don't score a century, and the betting is rupees 20. Now what happens? Say let's say on that day Sachin happened to score century. This person gets 20 rupees and the other person will lose 20 rupees. This is a simple form of betting, simple form of speculation. If Sachin don't score century, then this person will lose 20 and another person will gain 20 rupees. Very simple situation. Let's look at another situation. This person tells, yes, Sachin will score a century, and the terms are slightly different. The terms are rupee 1 for every run scored above 100. Rupee 1 for every run scored above 100. So if scores 90, that means he is below 100 by 10 runs. So you lose 10 rupees. Another person will gain 10 rupees. And if he scores exactly 100, yes, then it's 0, 0, exactly what you have bet. And if he score 105, he scored 5 rupees extra. So 5 runs extra, you get 5 rupees. Another person will lose 5 rupees. Are you understanding what is happening? Suppose if he scores 120, then you end up getting 20 scores extra, 20 runs extra means 20 rupees for you. Other persons will lose 20 rupees. Actually, this is a case of futures. I will discuss in detail, but try to think. In a way, one person is taking one position and another person is taking opposite position. In a way, that is called as futures, one of the popular instruments in derivative section. Anyway, let's try to understand slowly. Don't try to jump into any calculations. Now imagine one more situation. The person bets Sachin will score a century and telling rupees 20 in advance. Rupees 20 is paid in advance. Means rupees 20 is what he will score century. If he does not score century, not 1 rupee, 2 rupee gone, entire 20 rupee gone. Getting the situation? Previously what happened? Every 1 run above, I get 1 run extra, 1 rupee extra. If every 1 run below, I lose 1 rupee. Above +1, below -1. Here it is not like that. If he scores above 100, then only you get money. If he scores below 100, entire 20 rupees gone. No 1 rupee 1 run business if he does not score century. So, and if he scores above 100, every 1 run, you will get 1 rupee. Imagine these scenarios now. What will happen? If he scores 90, not 10 runs shortage, 10 rupees, no, entire 20 rupee gone. Whereas if it is 100, then you don't have to pay anything, but you have already paid 20 rupees. That 20 rupees gone. For you, it is 20 rupees loss. Another person, that is 20 rupee gain. If he scores 105, you are happy. He scores 105, more than 100. So you got 5 rupees. But what is the problem? You have already paid 20 rupees. You get 5 rupees now. 5 runs, 5 rupees now. But you already paid 20 rupees. Effectively, you lost 15 rupees. Other person will get 15. If he scores 120, you are very happy. He scores 120. So extra 20 runs, you get 20 rupees. 1 run, 1 rupee. But you have already paid 20 rupees, which means you are in no profit, no loss situation. And if he scores 130, then 10 runs extra, 10 rupees become 30 rupees, and for 30 rupees you already paid 20 rupees, and thereby you get 10 rupees. Other person will lose 10 rupees. This is a typical situation of option holder or option instrument. Another person, option writer, where you pay a fixed amount beyond which only you start making money. Below all these situations, you will lose entire money. Hope you're able to get the basic structure of it. And again, don't worry too much about individual little bit aspects. When we take up the instrument future, when we take up the instrument options, we will discuss in detail. Hope you're getting the flavor of it. That's what I wanted to bring it to your attention. The same thing will happen. We don't say betting in stock market. We say I take a view. Now Reliance is trading at 2,400 rupees. I take a view. It will go up beyond 2,480. I can take a position. Or I'll take a view, it will come below 2,400 as per my analysis, as per these calculations, as per looking at the chart, technical analysis, looking at the support zone, resistance zone. Reliance is likely to fall below 2,400. I take a position accordingly. I will have a view and I take a position. Where does view come from? My analysis, fundamental analysis, technical analysis. That is where view comes from. Where I take a position in these instruments, in futures, in options. If my view goes right, I make profit. If my view goes wrong, I make loss. And there are also some hedging instruments. There are various strategies possible to limit the loss, to limit the profit. We'll come to it. Essentially, these derivative instruments are created for hedging purpose, like insurance. But now it is used mostly for taking positions for speculation purpose. Okay. So we hope you understood the layers of it approximately from an overview, from a top angle. We yet to go into the individual details. Let's first understand a little bit more about basic structure of derivatives. Take a look at this picture. You have one wallet which has, let's say, uh, four 2000 rupee notes, or maybe five, I think, or five 2000 rupee note, or let's say five 2000 rupee note. And another same wallet, identical wallet, but has only 2000 rupee, only one note. Now, which wallet carries higher value? The second wallet or the first wallet? First wallet, right? Because it has 2000 rupee 5 notes. So value is 10,000 rupees. Whereas the second wallet, though same wallet, has only 2000 rupees. So the value of the wallet depends on what is there within that. So that wallet is called as derivative instrument. What is there within that is called as underlying instrument. We can also understand in one more manner. Derivative underlying asset. Take an example of gift coupon. Gift coupon which says 10% off on the computer you buy. If the computer value is 50,000, 10% off. So how much you get? 50,000, 10% means its gift coupon will be 5,000. Now next day, some announcement comes, some GST rate announcement is there. GST rate is hiked for some reason. The cost of the MRP of the asset, the cost of the asset became 60,000. The computer. Now what is the coupon is worth? 10% off. 10% off on 60,000 is 6,000. Now suddenly if the price falls to 40, 10% off, it will falls to 4,000. So look at the derivative. Now derivative is moving, the gift coupon is moving in tandem with the underlying asset. When the underlying asset increases, the derivative gift coupon value also increased. When the computer value decreased, the gift coupon derivative also decreased. Can you take a quick example of the, can you write down this one quickly? Intro to derivatives. Write down this example quickly. Okay. Hope you able to write it. Now let me look at the definition of derivative. The same definition is there in your FR also, in the chapter financial instruments. Same definition is there, we apply here. So for you to call it as derivative, there has to be three conditions to be satisfied. First condition, the value changes with respect to the underlying variable. Don't write it down, I'll give time to write. The value changes with respect to the underlying variable. The same example, see, the computer value changes, the gift coupon value will change. Initial investment should be zero or minimal investment. Zero means it should not have any value. For example, when you sign a contract, it will be zero value. Or like in this example, the computer value is 50,000, the gift coupon value is 5,000. The value of the coupon should be much lesser as compared to the underlying variable. Initial investment should be zero or minimal investment and settled at a later date. See, when I show you the gift coupon, then I'll be able to purchase the computer at a discount. I'll be able to show the gift coupon later. Settlement at a later date. Examples, future contracts, forward contract, options, interest rate derivatives. Underlying asset may be shares, underlying asset may be index, underlying asset may be foreign currency, it may be interest rates, it may be commodity, gold, and so on. Please write down this chart also quickly for your reference. Okay, I hope you have written this. Okay, so let me go further. Next, what is derivative? Let me just give one more angle to it so that the basic stays strong in your mind. So when I go to stock market, I will be able to select specifically spot market separately, derivative market separately, segments. So we say segments in market, in stock market. So we have spot market and then we have derivative market. So when you place an order, when look at the data, you have to look at separately. In spot market, also we have two types broadly. One for long term, we say cash and carry or intraday settlement. One is intraday and the other is cash and carry. We say long term for delivery purpose. But you don't worry about the difference. Let's just understand a spot market. Spot market. Derivative contracts. Or when I say spot market, let me talk about cash and carry. Let me not talk about intraday parts. Let me talk about derivatives. In derivatives, we have two segments. One is future segment and the other is option segments. In options also we have two segments. In options also two segments are there. Okay, let me not come to that. What is the term? Let's just try to understand. I want to focus only on that. Future segment means it is a contract. Essentially, derivative means a contract. What is the beauty of contract? You don't make full payment today, right? It's an agreement. You don't make the full payment. Spot price 1,000 rupees. You have to pay 1,000 rupees directly. Future price 1,000 rupees. You're not paying 1,000. I am agreeing to pay 1,000. So future, it's an agreement to pay certain price. Agreement to pay price in future. And here it's called as future price. Whereas in options is also an agreement. How it is different, I'll come to it later. It's also an agreement to pay in future, and that is called as strike price. So in future we call it as future price. In options it's called as strike price. Both are agreed today but payable at a later date. It's an agreement. Derivative means a contract. In spot market there is no agreement. Cash and carry. Cash to be paid immediately. Cash to be paid immediately. There is no agreement price. You pay the cash, you get the shares. The shares will actually come to you 2 days later because of T+2 settlement, but it will come. That is a operational aspect. Cash and carry, you make the payment, you get the share. So this is the segments in market. So what we have understood so far, my dear friends, the concept of derivatives basics, and the concept of segments in market, spot segment separately, derivative segment separately. In fact, as a stock trader, I will tell you, stock trader, we will do mostly our 95% of our trading will happen in derivatives only. The outsiders don't know this. A stock trader who's a full-time trader, who calls himself a stock trader, will mostly transact in derivatives. And the two in derivatives, 95% of the transaction happens in options practically. But for exam purpose, future comes for more marks. So for exam purpose, futures and options, we are trying to keep it equally, but practically we focus on options more. Hope you are able to get these basics. Yes. Yes. No, profit or loss will come when you exit. But what I'm trying to tell you is future is a contract. Option is also a contract. And how they are different, how they are exactly operated, we'll come to it little later. This is just to give an idea that you, at least when you make a payment, you're not making a full payment. In options, when you buy options, you don't make a full payment. Like if you purchase one option, you will have 1,000 shares. You're not purchasing 1,000 shares. You'll pay a little bit less. And what is it called, and how it comes to your account, operations part, interpretation part, we'll come to it later. But one thing is sure, in both of these cases, the full payment is not made at the beginning. Some partial payment may be there. That's the definition of derivative, right? It requires zero investment or minimal investment as compared to the underlying asset. We'll compare. Actual data will take it and we'll try to compare the numbers. Okay. This I might have given it to you earlier, but I'll just discuss it once more. Just a recap. No need to take it down. You buy HDFC share today at 100 rupees. After 1 month, if the share price goes to 110 rupees, you make a profit of 10. If the share price comes to 95 rupees, you make a loss of 5 rupees. Spot segment, cash and carry segment. So in spot market, you have this situation of 110 making a profit, 95 making a loss. So you want a protection. So what do? You enter into an agreement to sell at 105. You sign a contract at a fixed price. Agreement to sell a share at a particular price. The price is fixed today itself. So after 1 month, if the market price is 110, you will have to sell as per your agreement at 105. You make a profit of 5 rupees. After 1 month, if market price comes to 95, still you need not worry. You have to sell at 105 as per your agreement. You make a profit of 5 rupees. If you want to write down, I'll give you time to write down. First, try to understand the concept. So you see, in spot market, it was profit or loss, uncertain. Now here, we signed a contract and we protected our profit. So what happens? Whether market goes up or market comes down, this agreement will make sure a fixed amount will come to you. This is essentially a future contract. You're signing a contract today for agreement, for settlement at a later date. Actually, this is called as hedging, where you protect your profit, where you protect your cash inflow. But what happens? This has been used mostly for speculation purpose. We'll come to it later. But primary purpose for which these instruments are created originally for hedging purpose. So I'm giving that example. So don't carry this example throughout the chapter, but to get an idea why the future market was started is to protect your profits. Now it is used for different purposes. We'll come to it later. Okay. Now comparing these two situations, which is better? Going to spot market is better or future market is better? Some people say spot market is better. You can make profit up to 10 rupees. Some people say, no, future market is better. Even when there is a loss, you can make 5 rupees. And an intelligent person will tell, I want both. If market comes to 110, I want to sell in the market. If market price falls to 95, I don't want to go to market. I want to come to the future market. I want to execute my agreement. So, I don't want an obligation in my agreement. I want a choice. I want a discretion. I want to make the decision later. I want to keep my options open. That is, here also you sign a contract. Here also you sign agreement. But what agreement? Not agreement to sell. Observe carefully. Agreement to having the right to sell, discretion to sell, choice to sell. So if market price comes to 110 rupees, yes, it is better to sell in the market. This agreement you cancel it. Can you cancel the agreement? You sign the agreement. Yes, agreement did not give me obligation. The agreement gave me a choice. The agreement gave me a right. The agreement gave me a discretion. So, agreement allows me. If I want, I can exercise. Otherwise, I will cancel. Now here, going to market is beneficial. I'll go to market, sell it at 110 rupees. I make a profit of 10. This agreement, I will cancel. If price falls to 95, then I will tell, then going to market is not beneficial. I'll come to this agreement. Agreement, I would like to use it. I will sell it at 105. I make a profit of 5 rupees. This agreement, where you have a right to sell, is called as options market. And for example purpose, I told you earlier, or no, I remember, spot market is like Swayamvar. On that day, we don't know what kind of person will come. Future markets is like engagement, agreement signed today for a price also, you understand. And on that date, if the market price goes up to 110 or market price comes down to 95, they're all opportunity cost. Your profit is fixed. On the date of marriage also you see. You can see person left side, right side. You can't do anything. They're all just opportunity cost. Options market is like living in relationship. You have a choice open, but it comes with a cost. So for this right, you are getting a right, you are having a choice. That right does not come free of cost. You have to pay for that right. That's called as option premium. We'll discuss later. You can write down this quickly for your reference. Just the basics. We are not going too much in detail. We are slowly entering this prohibited area. Please write it down. We are just exploring different segments in the stock market. Different segments. Okay. I hope it is done. Okay. Okay. Let's move further. Uh, Before we enter into the individual segments one by one, in derivatives, some terminologies that you have to understand carefully. Let's spend time on that now. First one among them is speculation, then hedging, arbitrage. I started this future option, this chart what you've written is with the help of hedging, but it can be used for three purposes. In the exam also, once you identify that the problem is from options, what is the purpose of this? You have to analyze. In practical life also, when you take a position, you have to ask yourself, what is my position? Am I speculating? Am I using this instrument for hedging purpose, or am I doing for arbitrage purpose? Arbitrage, after this technology invention, internet, this softwares and all, is minimized, but here and there opportunities exist. I'll explain. First, let me talk about speculation. Okay. Now, when I use the word speculation, some people say it is betting. Yes, in a way it is betting, but please don't really think speculation means betting. Here, the word we use speculation is not for betting. The word we use the speculation for uncertain purpose. We have some uncertainty, we don't know the future, so I'm using the word speculation. So please don't think it is betting. In a way it is betting, because betting also uncertain. I don't like that word betting continuously, so I use the word speculation. Speculation means taking a position where future is uncertain. Let's write down speculation, taking a position or doing some activity, taking a position where the outcome is uncertain, where outcome is uncertain, unknown. You are writing CA exams. Is it speculating? No, no, sir, not speculation. I'm writing exam. Exam is speculation only. Why? You don't know the question paper. Just like that, I buy the shares. I don't know whether share price will go up or not. I think it will go up, or I think it will come down. I think I will write the examination. We don't know what will happen. The future is uncertain. In fact, everywhere is uncertain, right? The life is uncertain, traffic is uncertain, education is uncertain, health is uncertain, your life is uncertain. After 1 year, we don't know what will happen. 1 year back, did you know that coronavirus will come now? Or when you do a job, do you think job will always be there? Is it completely certain? You have office, you have clients. Are the clients guaranteed? There are mixture of everything. So life is a game of probability, not a game of certainty. So in stock market also, we take some position, having some view, that's called as speculation. In spot market also we do, in future also we do, option also we do. It is treated like a betting in some reason. It is similar to betting in some reason, but not always. So we can say that it is in some features. When I say speculation spot market, some features are similar to betting. Some features are similar to betting, like you have ultimately zero sum game. Zero sum game. One person's profit is other person's loss. Zero sum game, and it is highly speculative in nature. Yes, I think zero sum game. That's the only point I would like to say. Some features are similar to the betting, where you take a position, zero sum game. You make some payment. That is one person's profit. One person's profit is another person loss. Because in stock market, many people use these future options for this purpose. Many people use, so it has become, oh, derivative means speculation. It has become like that, but primary purpose of derivative is different. But anyway, And speculation is the word. Don't take from income tax angle also. Okay, in the income tax angle, speculation means what? Speculation profit. You have a separate profit, right? Income from business profession, regular business, and income from speculative profits. Profits and loss cannot be set off. Speculation means settlement without the physical delivery, right? And there, this F&O segment has been taken out. In income tax definition of speculation, F&O is not there. Just for income tax suggestion, income tax gyan. But anyway, here when I use the word speculation, I'm not talking about income tax speculation. Here when I use the word speculation, I'm not talking about general people word speculation. I am talking about the word uncertainty. If things goes according to expectation, I make profit. If things goes against me, I'll make loss. This intention of uncertainty, outcome is unknown. That is what I'm using the word speculation. We are speculating about our career. We are speculating about our CA exams. Anything uncertain, I'm using the word speculation. So futures and options can be used for speculation as well. For example, I am having a position in Reliance. I think Reliance share price will increase. So what do? I take a position in Reliance futures. What is the difference between taking a position in Reliance spot and taking positions in Reliance futures? I will not discuss it now. I will discuss when I go to the futures part. Basically, it requires less money. In spot market, how much ever money I will pay, I will not pay so much of money in the future market if I take a same position. My profit or loss will be same, but I don't make so much of payment in advance. Anyway, I'll discuss that in detail when I come to the uh, future segments in detail. Okay, after speculation, now we have hedging. Hedging is essentially risk management technique. See, I told you because there is uncertainty, there will be speculation. Now, on one variable, we have a risk. So, I would like to manage that risk. If possible, I would like to avoid that risk. We can't avoid the risk. I can only manage the risk. I can minimize the risk. Hedging is a risk management technique. It's a process of reducing or minimizing the uncertainty. We will have various strategies built to reduce your risk. You have a health risk. You might fall sick anytime. What do? You take health insurance. You might worried. You are the sole earning member of family. If you die, your family may be affected. You take life insurance. You take term insurance. You are worried. What if accident happens to the car or to your life? You take motor car insurance. You take accidental insurance. You cannot avoid rain, right? Can you say, stop rain? Rain is not good for my business. Or rain, I cannot go out and work. You cannot stop, but you can use umbrella. That's what is hedging. Or popularly I say, have a backup before breakup. That is what is called as hedging. Anyway, don't take it seriously. I hope you understood the basic purpose. Now I have a portfolio. Now I'm worried because of coronavirus, Delta virus, Omicron virus, something, I don't know what and all they'll give a name. Like they're giving new children, they're giving new names. I'm worried about stock market falling. So this portfolio value, I want to protect it. Now what do? I take a position in futures. I take a position in options. So that even if the market falls, my portfolio will give me loss. But this, what I selected, options or future instrument, the hedging instrument is going to give me profit. So this loss will loss will be covered by some profits. So this process of having two positions, okay? You are having an existing situations, creating a loss or creating uncertainty, and to avoid that uncertainty, to manage that uncertainty, we create one more instrument. That one more instrument, one more position we take as then parallel to existing position, that is called as hedging instrument, and this mechanism of creating a opposite position is called as hedging. Futures can be used for hedging. Options also can be used for hedging. We will come to it in the days to come. Hope you got it. You can write down this. I'll just give you time a little bit later. Only these 3 points you have to write down. Last one, using for arbitrage purpose. What is this arbitrage? Arbitrage means taking the advantage of imperfect market price. Or buying at a cheaper price, selling at a higher price. What do you mean by that? Let me explain. First of all, let me tell you, arbitrage is an opportunity. You don't find that opportunity regularly. The moment you see the opportunities, you have to encash it. I'll give an example. Let's say two shops are there. Two shops are there next to each other. In one shop, uh, let's say Good Day biscuit is sold at 20 rupees per packet. Now, next shop, do you think he will sell at 20 rupees or can he sell 21 also, 19 also? If you think theoretically, he can sell it at any price. But he will also be selling at 20 rupees because if he sells at 19, what will happen? Everybody goes to him, this person forced to sell at 19. If he sells at 21, everybody goes to this fellow 20 rupees and therefore other person forced to sell at 20 rupees. That's the beauty of pricing in the market, any market for that matter. Or you can also think another way. Suppose in one shop, a vegetable is selling at 100 rupee per kg. Tomato, I think, nowadays, tomato price increased. 100 rupee per kg. In few shops later, same tomato, same quality, if quality different, price can be different. Same quality is selling at 105. Now what can happen? Intelligent person, what can I do? Forget about the consumer. If he is a vendor, what will he do? He will buy at 100 rupees, sell it at 105. Thereby, he makes an easy profit of 5 rupees. Now, what happens in this 100 rupees? The buying pressure happens in 105 market. The selling pressure happens because of buying pressure, selling pressure. The price will reach a equilibrium. 105, 100. 105 will come down, 100 will increase. Equilibrium will be maintained. That is what is called as arbitrage, taking the advantage of imperfect market price. You see, we have two markets, right? We have NSE, we have BSE, popularly in India. Suppose if I take Infosys shares, do you think share price will be different or not? Let's do one thing. Let's go to the website and check it out. Whether they are different or same. So I'll go to NSE website. Hope it is visible. NSE website. And there I select Infosys. And what is the share price? Can you see? 1717, right? 1717. That's the share price of Infosys in NSE website. Hope you can see it. If I come to BSC, let's look at what is Infosys share price. There it was 1717, and here it is 1715. You can see, I don't know whether you can see 1715.5. 1715.5. 1716. You see only 1 rupee difference. So if you want to do arbitrage here, you buy in 1715 and sell it 1717, the brokerage will eat away all your profits. Uh, the, tran the transaction price will eat away all your profits. You really will not have any profit left. So, are you understanding the point I'm trying to tell? Arbitrage means we compare prices in the two different market for a same quality of the product. If it is for different quality, the price cannot be compared. So, the prices between two markets for same quality product must be equal. If there is uncertainty or if there is disparity, then there exists an opportunity. What opportunity? If you're a consumer, you can buy at a cheaper price and thereby the buying pressure increases. Other person forced to cut down his price. If you are a trader, you can make use of that opportunity, buy at a cheaper price, sell at a higher price, and thereby you make guarantee profit, you make certain profit, you make riskless profit. So, what are the terms we associate with arbitrage? So, arbitrage, we can use the word riskless profits, or we can use the word certain profit, or we can use the word guaranteed profit. So, when the arbitrage opportunity exists, profit, when the opportunity does not exist, price is same. You can't buy in one place, sell in another place, you can't make profit. If arbitrage opportunity exists, then the price is different and thereby you can buy at a cheaper price, sell at a higher price, thereby you can make riskless profit, or you can say guaranteed profit, or you can say certain profit. If there is any excess profit available, that is what is arbitrage. And let me also tell you, it is an opportunity. That is, arbitrage will be an opportunity available for very short term moment. That too, it's almost non-existing now. So, the price will be stabilized over a period of time. In the sense, if there is arbitrage opportunity, you should be very attentive to catch it. If you miss, arbitrage opportunity will be taken away and price will become same. The opportunity will be lost. So, the market will correct itself. Uh, you can write down, but before that, whenever somebody is making riskless profit, unnecessary profit, market will always have a mechanism to correct itself. This philosophy works at a larger stage also. Two examples I gave. You know the data internet what we had 3 years back, 4 years back, before Jio came in. Airtel was there, Vodafone was there, some Tata Docomo was there. How much they were charging for the internet data pack? 1 month, 1 GB means they used to charge heavily. Basically, they were taking advantage. Now, when Jio came in, 1 day 1 GB not sufficient. Everything is happening online now. I'm sure some of you might be watching these classes also on Geo. But how could they make it? Not because they had money, it's because there was opportunity. These people were selling this data at a very high price. Those people saw the opportunity and made use of it. And now everybody is forced to sell at the same price, reasonable profit. So if somebody makes too much of extra profit, a market will correct itself. In olden days, I don't know whether you heard of our mythological stories or history, whatever you call, that Rakshasa will be there, and Vishnu will make some avatar, and he has done Dashavatar. He, not Kamal Haasan movie, he makes a different avatar and he kills that demon. He kills that Rakshasa. I think the new days avatar, I call it as new startups. One of them is Geo, who killed the existing, or at least who rationalized the internet charges. And even in brokerage, I must tell you, the brokerage, this HDFC cap, SBI cap, they were charging so exuberant brokerage, the trader was finding it very difficult to make profit. There was a saying, uh, traders make loss when market comes down, trader makes loss when the market goes up. Only person who makes profit in both the cases was broker, stock broker. They were charging 2%, 1% upside, 1% downside. So if you want to make a profit in a stock in a day, it has to move by 2% in a day. That's very difficult. So when there was vacuum, when there was exploitation, Zerodha came in. They could use the opportunity. Now the brokerage are discount broker mostly rationalized. So arbitrage opportunity can be identified at a very small level, as even to a shop, small shop next to each other. Arbitrage opportunity can be applied at a stock level. I told you NSE, BSE, Infosys share price. Arbitrage opportunity can be applied even at a product level. The brokerage example I gave you, internet data packages example I gave you. Ultimately, arbitrage means we have two markets, the prices are different, we have an opportunity there. And what simple opportunity? For our example purpose, you buy at a cheaper market, sell at a costlier market. When you keep on buying, when you keep on selling, the prices will be stabilized. Prices will become equal. Thereby, the arbitrage opportunity will be taken away. When more and more people use that arbitrage opportunity, that will automatically be taken away. See, one more example I give you. In traffic, in road, we have a road like this. But in divider, there is some gap. So what this two-wheeler will do? Suddenly they will take it and bypass that signal. One person pass, other person also follows, other two-wheeler also follows. That was arbitrage opportunity. So one person identified the opportunity, others followed it. When too many people follow it, what will happen? Then only traffic jam happens, right? Because everybody follows there. Or if traffic department or the police department or if the government was serious, they come and block that, make it straight, equal for everybody. So arbitrage opportunity is opportunity where there is a price disparity. You should take advantage of it. As and more people take advantage of it, the disparity will come down, the parity will maintain, both will be equal, means arbitrage opportunity will be taken away automatically. So what is application in derivatives? We have a spot market, we have a future market. Now essentially the future price should be derived from spot price. Future price of Reliance, spot price of Reliance. If there is a disparity, then you can buy in spot market, sell in future market, or buy in future market, sell in spot market. You can make strategy, arbitrage strategy, where you can make riskless profit, guaranteed profit. We also have arbitrage funds. Mutual funds are there. There in mutual funds, we have debt funds, we have equity funds, we have balanced fund, we have arbitrage funds. What arbitrage they make? How do they make it? We'll come to it when we understand the futures. Then we can go for the detailed operations. So you can take down these three important objectives. In general, if you have any doubt, get it clarified. Just understand the purpose. Detailed operations, don't worry. Just understand the purpose. Okay, hope you are able to take down. Okay. So this is about the objectives of derivative instruments. Few more some terminology if you have to understand. Some basic assumption that we have. Settlement types we have to understand. And more importantly, very importantly, this long position, short position. Take down this chart. We'll discuss about it one by one in detail now. Please take down this chart. Okay. Now let's talk about it one by one. The first point, zero position. It's a very interesting point. So what I'm trying to tell you, I would have told you the basics also. I'll discuss it once more. In SFM, in financial management, in derivatives, for valuation purpose, for transaction purpose, assume you are in zero position. In so many places, we have to make use of this. Means whether your source is own funds or your source is borrowed funds, we have to consider the cost in both the cases. Or we ignore the source, we just focus on the application side of it. Own funds, borrowed funds. Borrowed funds has a cost. If you take a loan, you have interest. But if you borrow, if you use own funds also, cost is there. Yes, that's what is opportunity cost. When a billionaire or Ratan Tata or Mukesh Ambani, do you think they drive their own cars? No. Why? The drivers will be there. What is the purpose? In those time also they can think their time is more valuable, their opportunity cost. Their time is more valuable than driver time. Therefore, they would like to spend time on something else. Own money also has a cost. Own resource has a cost. Own time has a cost. Opportunity cost. If there is a 2 hour free session, 2 hour free session on some topic, audit, income tax, GST, don't go and attend just because it is free. Even that free session has a cost. You have to spend time 2 hours. Once that is gone, it will not come back in your life. That has a cost. And in fact, it is the most costliest cost because you cannot value it. And that too in Indians, anything free, we would like to take it. Even if it is poison, we'll take it. It might be required for some time. It has a cost. At home also, just because something is there, scrap is there, don't keep it. It might be required later. Even if it is there, it will have a storage cost, it will have occupancy cost. Try to make yourself as free as possible. Anyway, I should not go for non-subject topics. Let me come back to this. I have I have received a lot of complaints that I go off out of the subjects quite frequently, so I have to come back. Opportunity cost. You are in own house, you are in rented house. In a rented house you pay rent, outlay is there. In own house, had you given your house on rent, you would have made income, rental income. You are giving up and then you are staying there, you have an opportunity cost. Of course there has to be opportunity. If your house is in important center heart of the city like MG Road in Bangalore, yes, there is no point in staying that house. You can give rent and stay somewhere nearby. But if your house is in somewhere 40 kilometers away from city, there is no opportunity. So there we don't talk about opportunity cost. Where there is opportunity only, there can be opportunity cost. Okay, so keeping it all aside, what point I'm trying to tell here is this. When I say zero position, it means I am trying to tell you we are valuing futures, options, derivatives, keeping the source constant. So if you are valuing an option, I'm valuing futures, I should consider the borrowed funds will have a cost, own money will also have a cost. If I'm investing my money in fixed deposit, I expect 6% return. If I'm investing in equity share, at least that 6% should come to me because I take more risk there. At least that should come. Whether comes or not secondary, we are focusing on expectations. That's what it means by zero position or opportunity cost. So zero position opportunity cost means, or you can write down in this chart, you can write down, you have written zero position opportunity cost. This means own borrowed funds will have interest cost, own funds. Okay, I'll write separately, that's better. Okay, so what is the zero position means? If it is own funds, you will have opportunity cost. If it is borrowed funds, it will have interest cost. So basically, every source of funds will have a cost. Will have a cost. Will have cost for valuation purposes, for strategy purposes. For when you are creating strategies, means when you're taking position, or for valuation purpose, or valuation. You're valuing options, you're valuing futures. You should consider these points. Every source of funds will have a cost for strategies or valuations. And some strategies will have to assume zero position. What is that assume zero position? If I say my strategy is to buy shares, where is money I have? I have to borrow money. If I borrow money, it will have a cost. If I use my own money, it will have a cost. Or if I want to sell shares, I want to borrow shares. Borrowing shares will have a cost. If I have shares already, it will have a cost. So you can also mean zero position also means if the strategy is to buy shares, means we have to borrow funds. If the strategy is to sell shares, we have to borrow shares. So what is borrowing share concept and all, we'll come to it later. But what point I'm trying to tell you is if you do something, you have to start with the borrowing. I am at zero position. I don't have anything. Even your life, let me not go back out of the subject, but still I want to say this. Even your life, when you are born, you started with zero. Everything else is given by somebody else. This body is accumulation of the food that is taken from this nature. This mind is taken from the societies. It's an accumulated body, accumulated mind. So honestly, you really don't have anything. So don't ever think in your life, my body is great or my mind is great. I am a CA, I can rule the world. Please take out all those myths. It might look philosophical, the formula is financial. Zero position. You started with zero, your life ends with zero. So you started with nothing, everything is accumulated. Body, mind, knowledge, food, wealth, everything is there and you accumulated. Nothing you created. If you create, you would become God. Anyway, so let me not go to the other side. Zero position means start with zero position. Every source will have a cost. Remember that much sufficient. Every source will have a cost. Regarding strategy, I'll come to it. We should talk about it a little bit later. Long position, short position, especially there, I will talk about this. Hope you have written down this much. Okay. Uh, we have two more important basics to understand. That is this long position, short position, and settlement types. Both are very important. So I have to do a little bit in detail. So let us take a break and then we'll continue. So take a break of 10 minutes, then we'll continue. Take a break of 10 minutes. Okay, so moving on. Hope you are back. So we understood the concept of zero position. Now let me talk about the concept of settlement types. Settlement types. Two methods of settlement. One is settlement by delivery, and the other one settlement by cash, or also called as net settlement basis. Net settlement. Okay, now these are all applicable mainly for agreements. So especially when we talk about future options, derivatives, how the settlement is going to take place. You would have also learnt in FR. If the settlement is by delivery basis, one treatment will apply. If settlement by cash basis, one treatment will apply. Anyway, I will not talk about FR. Let me talk about the purely derivative here. One example, let's say. If you entered, okay, today, let's say today is just an example, 1/1/2021. Example purpose. We are end of it, but still, example purpose. Today on 1/1/2021, you entered into agreement, contract, entered into an agreement to buy some product, maybe some chemical or some vegetable, some fruit, some raw material, something, I don't know what it is, to buy material. I'll just say material, some material, some product at rupees 100 per kg on first on 31st of uh, December 2021. So 1/1/2021 is date of signing the contract. 31/12/2021 is date of execution of the contract. Very clear. On 31st of December 2021, on 31st of December 2021, what is the market price? Let's say if the market price of this material on this date of settlement, date of execution, the market price of this material, whatever is the material we discussed, is rupees 105. Is rupees 105. Now you tell me, where will you buy this material? Will you buy the material from the market, or will you buy this material from this person with whom you have entered into an agreement? First of all, you don't have a choice. You have entered into an agreement. Market price does not matter. Okay, now at least tell me, are you making a profit or are you making a loss? If you go with regular process, what is regular process? I signed a contract. As per the contract, I have to buy. Let me execute the contract. Let me honor the contract. What will happen? That is what settlement by delivery basis means. So what do you do in settlement by delivery basis? What do you do in settlement by delivery basis? You execute the contracts. You execute the contract. That is what execute the contract means. What I am going to honor my agreement. As per agreement, I was supposed to purchase. I will purchase by whatever the cage is. Buy the material by paying rupees 100. You buy the material by paying 100. You have honored the contract. You have executed the contract. You have completed the agreement. Simple. Now you have the material with you. What you can do? You can go to market, and in the market is selling at what price? It is 105. Therefore, sell this material. Sell this material in market at rupees 105, and thereby you make a profit of, hence you make a profit of 105 minus 100, that is 5 rupees. Simple process. Execute the contract, make a payment of 100 rupee, get the material, sell this material in the market, market it at 105, you make a profit of 5 rupees. This is what settlement by delivery basis means. Please write down till here and let me know if you have any doubt. I'll go in a stepwise manner. Don't worry. Any questions up to this settlement by delivery basis? So we have done settlement by delivery basis. Now let me tell you how the transactions will be settled if it was by settlement by net basis or settlement by cash basis. What the other person will tell. You will pay me 100 rupees. I will give you material. You go to market and make a profit of 5 rupees. Instead of that, I will only give you 5 rupees. You made your profit. Ultimately, what is your profit? 5 rupees. No difference between from me you buy at 100, you go to market at 105, you make a profit of 5 rupees. That 5 rupees I will only pay you to you. Let's cancel the agreement. You are happy, I'm happy. We can save all these transaction costs, unnecessarily delivery things. That is called as settlement by net basis. Settlement by net basis. So in this agreement, what is happening? Earlier, we have executed the contract, right? Here, what happens? Here, contract is cancelled. Contract is cancelled. And net amount, differential amount, or you can say net amount. What is this differential amount? 105 minus 100, 5 rupees. What is 105 minus 100? The current market price current market price minus agreed price, whatever price as per agreement. Price as per agreement. Current market price or price as per agreement 105 minus 100 5 is received or paid by another person. So what is important? This is important overall. In your settlement by delivery basis, how much is the profit? 5 rupees. Settlement by net basis, how much is the profit? 5 rupees. So what is important learning out of these two? Under two methods, the method of settlement change. The mode of operation will change, but the overall profit, final profit or loss will remain same. So under the two methods, mode of operation changes, mode of operation changes, but overall profit remains the same. Overall profit remains same under both cases, under both methods. Under both methods. It is important. In future also I am going to discuss in arbitrage strategy. If settlement by net basis, settlement by delivery basis. I show different modes of operation, different transactions, but ultimate profit under both will remain same. In exam question, they may not mention. Explain settlement by net basis, explain settlement by delivery basis. They may not mention it. So we can use either methods. Sometimes they'll give a hint. You have to solve by net basis. You should be aware of it. Hope you got the broad structure. Settlement by delivery basis means contract is executed. Settlement by net basis means contract is cancelled and the differential amount either received or paid. It may also be paid, okay? Market price went to 105, you made a profit of 5 rupees. If market price comes down to 95, yes, you have to pay out of your pocket. So it would have been 5 rupee loss. Instead of 5 rupees coming to you, you have to pay 5 rupees. That is settlement by net basis. Okay, hope you have written. I'm going to make a summary chart also, don't worry. Okay, now there is one more argument possible. Sir, this treatment is applicable for a trader who buys and then sells. He makes a profit, net settlement makes sense to him. What about the person is a manufacturer? He is entering this agreement because he needs raw material. The person may be car manufacturer, he needs a tire. He entered into an agreement to buy the tire. Now, can he tell the customer, you go and buy the tire anywhere? The manufacturer needs the raw material. Then, how this calculation will work out? Will still the situation be same? The answer is yes. How? Take a look at this. Now, if the person was having intention or the person position is manufacturing, he will buy at 100 rupees. He will not sell it at 105. He buys the material, he consumes, he manufactures the finished goods. So what is this 100 rupee will be for him? Cost of material purchased. If you are a manufacturer, you are not going to sell this material. This 100 rupee will be for you cost of material purchased. Correct. What about net settlement basis? Same thing will be achieved. How? Now you received 5 rupees on net settlement basis, but you need the product. When you need the product, you go to market and buy it at what price? 105. Now 105 you will buy. You have received 5 rupee profit. So what is your effective cost? 105. 105 you pay, 5 rupees you receive. Effective cost is 100 rupees. So even for a manufacturer, this cost will remain same, of course, subject to transaction charges, brokerage, traveling. But in our discussion theory purpose, the transaction charges are not there. I mean, we cannot take everything into consideration. That will be too much of thing in one place. But in general, even for a manufacturer, settlement by delivery basis, settlement by net basis makes no difference. In both the cases, you will have same conclusion. Overall position will remain same. So all these things will write by a short manner so that things will be very clear. So write this chart. Let me explain. Give me 1 minute, then you can take it down. Settlement by delivery basis, physical exchange of goods, amount will be paid as per agreement. If the intention is to sell in the market price, you make profit, difference 105 minus 100. If the intention is to consume, no further transaction. Whatever amount paid will be your cost of purchase, cost of material consumed, 100 rupees. If settlement on net basis or cash basis, then there is no physical exchange of good, means the contract is cancelled. And cash paid or received is difference between market price minus agreed price, may be favorable, may be unfavorable, may be financial asset or financial liability as per your financial instrument in FR. If intention is to sell, yes, no further transaction, amount received is your profit. If the intention is to consume, then the you are going to purchase from market price 105 rupees in my example, and 5 rupees profit you already received. Net amount is your cost of material. So cost of purchase is market price minus cash already received. Cost of purchase is market price minus cash already received. So ultimately, in delivery basis, contract is honored, executed, contract is executed, and in net basis, contract is cancelled. But remember, overall position remains same under both the methods. Overall profit is same under both the methods. Overall profit or loss. So please take a note of this chart. If you have any doubt, get clarified. Then we'll go to important topic: long position, short position. Uh, Hope it is completed. Okay, I'll go further. Hope it is done. Okay, so now we'll move to one important area: long position, short position. Many people get confused here. So let's spend as much as possible time and let's do as slow as possible in this area regarding long position and short position. Position. So we can take two position here. Either you can take long position. Please write along with me. You take long position or you can take short position. Okay. Now basically when I say taking position means I'm taking a view. Position means taking a view, having opinion, taking a view. Now, let me ask you one simple thing now. We are in the month of December 2021. Soon we will become 2022. Now, Corona was there, many years are over. Now people are talking about some Omicron virus, some third wave, something. Now, what do you think? Stock market will go up or stock market will come down? Some people think, oh, this is again one more serious situation. Stock market will fall. And one more opinion may be, we have fallen already. Why will we fall again? We have reached Nifty 18,600. Now we are at 17,000. So we have already fallen. We don't fall further. Now from now onwards, we'll go up only. Market always is interesting because of the opposite position. Let me always remind you, a stock trading will take place only when one person want to buy, one person want to sell, and the person who is buying things, he is smart by buying, and the person selling things, he is smart by selling. Who is right? Only time will tell. But we need the people with opposite expectations. Person who needs money, person who have money, person who needs job, person who have job, right? We always require two opposite persons to make the market happen. If everybody is having same opinion, stock market will not survive, life only will not survive. So taking a view, one person will take a view, market will go up, market price will go up, maybe overall or individual stock or for commodity or for gold, silver, oil, copper, everything. If you take a position, market price will increase. That is called as long position. So long position means taking a view, taking a view market price of any product, any commodity, any share, any index. In general, market price will go up. That is my opinion, taking a view. So I take long position. Short position, opposite view, taking a view. Market price will go down, market price will fall, market price will go down. This taking a view that market price will go up will also say nature is bullish. I am bullish about Reliance. I am expecting Reliance share price will increase. I am going long in Reliance. If somebody say I'm going wrong, I'm going long, you don't tell go. Means when you say I'm going long, that means I'm having a bullish view. That means my thinking market price will go up. Short position, I'm going short on this stock, I'm going to short this market. There is a good movie in English, The Big Short. In 2008, the Lehman Brothers crisis, what happened, that is explained in this movie, English movie. If time permits, please watch that movie, The Big Short. SHORT, The Big Short. Nice movie it is. Short means I'm expecting the market price to fall down. In general also, right, the long fellow like things to come up. Long fellow, no, he can catch it easily. Short fellow like things to fall down. Short fellow don't like to catch up, he want things to come down. So long position, expecting the market price to go up, expecting. Short position, expecting the market price will come down. And in long position, you expected market price will go up and actual market price went up. Actual market price is up. Let's say actual market price is up. Means your expectation comes true. Therefore, you make profit. Your expectation was market price will go up, and yes, it did go up, and therefore you make a profit. How much profit will come to it later. But if reverse happens, if market falls, goes against your expectation, yes, you'll have to suffer loss. If it falls down, if actual market price is down, if actual market price is down, falls against your expectation, yes, definitely you will end up suffering loss. Suffering loss. And similarly, in the short position, you're expecting the market price will go down, and if actually it goes down, actual market price is down as per your expectation, then you make a loss. Sorry, you make a profit. You make a profit. I forgot to tell one more point. When you take a long position, it is same as calling yourself I'm taking a bullish view. And short position, that is I'm taking a bearish view. Not bearish, bearish. They are referred to animals, the nature of the animals. How bull attacks, how bear attacks. We also use the terms in stock market a lot. If the market is down, we say bears are under control, bears. And if the market is going up, we say bulls are under control. They keep always arguing, bull and bears. Market keeps going up, coming down, and ultimately who wins? Of course, only the time will tell. And nature of bull, how bull attacks directly goes there or from the top, and how bears attacks from the bottom. So I'm becoming bearish means I'm expecting market price to fall down. Again, it's not bear, okay, bearish. In bear also people will fall, but this is bearish, name of the animal, bear. Okay, now if market price is up, what will happen in short position? Actual market price is up. then what will happen? You are expecting the market price to make to fall, but market price went up against your expectation, so you end up making loss. So in stock market, when the market is falling you can make profit, when the market is rising you can make profit, as long as you have a proper view. You see, when the market price going up you are making profits, when the market price going down you can make profit, as long as you take a appropriate position. Reverse also can happen. It happened to me as well. I had taken a short position thinking that market price will fall, but against my expectation, market price went up. Everybody is happy. I am not happy because market price went up, but I took short position. I shorted the market. Market went against my direction. Loss. Even when the market goes up, I make loss. But in long term, market price will go up. In long term, price will increase. In long term, things are always going up. So we use the word long position. Short position, we cannot have it for long term because we can have a bearish view only for a short period. In long term, market will not come down forever, right? In we grow, our life will grow, expense will grow, age will grow. So in the long term, it is going up. So we use the word long position. But please don't think that. Long position means taking a bullish view, expecting the price to go up. Short position means taking a bearish view, expecting market price to come down. If things happens according to expectation, we make profit. Otherwise, we make loss. Okay. What is this long position means? Okay, I hope you have taken it down. Long position means you can also write down by one more manner. It means buy now, sell later. Buy now, sell later. Why buy now? Because I'm expecting the price to go up. I would like to buy at a cheaper price. Price goes up, I will sell, I make profit. My expectation. Things can go reverse. Short position is sell now and buy later. Sell now and buy later. Sell now and buy later. Because now I'm expecting the market price to fall down. So at present only price is high. Now at present price is high, I would like to sell, and later market price comes down, I would like to buy. Sir, how can I sell when I don't have? I will come to it. I'll come to it. I can also tell you, how can you buy? You don't have anything, zero position. I'll borrow money like that. In short position, you borrow shares. All those technical points, I'll come to it. First, let's understand the simple numericals. Hope you have taken this whole structure. I'll give you numerical example. I'll give you what are the series of transactions involved, especially short position. You have to be careful. Hope you have taken this whole structure. Okay, I'll go further. I'll take a simple example. Okay, example. Simple numerical example, not detailed one. Okay, now today market price, or let's take simple example only. Example, today market price is 100 rupees. Today market price is 100 rupees. You have a long position. You take a long position. What is long position? You will buy at 100 rupees. Long position means buy now. Buy at rupees 100. Later, market price became 105. Market price increased. So you sell at 105. You make a profit of 5 rupees. Bullish position, expectation was market price going up. Yes, it did happen. You make a profit. But later, if market price comes to 95 rupees, you have to sell at lower price, sell at 95, bought at 100, selling at 95, you have a loss of 5 rupees. Why loss of 5 rupees? My expectation was market price to go up. It came down. Therefore, in this situation, you end up making loss. Okay, now if you take a short position, what will happen? Had you taken a short position, what will I do? What I told you, you will sell first. Sell at rupees 100. What will happen in the first situation? If market price goes up, sell first, buy later. Buy at 105. You are selling at 100, buying at 105. So you will have a loss of 5 rupees. What is the reason behind this loss? Your position going wrong. Your expectation going wrong. Short position means expecting market price will fall below 100. It went to 105. It went in opposite direction. Yes, you have to suffer loss. Even when the market going up, you can make loss. When the market is coming down, if it is 95, you will buy at 95. Thereby, you make a profit of 5 rupees. Sold at 100, buying at 95. Difference profit of 5 rupees. Even when the market falls, you make profit. How? Because that's what you're expecting. Your expectation came true. Stock price did fall, so you make a profit of 5 rupees. So now, here I told you, right? You have to buy at rupees 100. Where do you get the money? You have to borrow money. And here I told you, you have to sell the share at 100 rupees. Where do you get the shares? You have to borrow shares. That's what I mean by uh, zero position. If your strategy is to buy, where the money comes from? If your strategy is to sell, where the asset? I have to borrow the asset. Anyway, borrow money, borrow shares. You just make a note of it. I'll explain in detail with the complete chart after this. But take the numericals. Let me know if you have any doubt. Okay, now how this long position happens, many people don't have any confusion because they say borrow money, yes, possible. But how you borrow shares, that's where people are not convinced. Some apprehensions are there, some inconvenience is there. Okay, but let me quickly tell you how the long position will work. Quickly, how the long position will work out. Okay, how the long position work out. What the pros I told you, you have to buy today, right? You have to buy today, buy shares today. And for you to buy, where do you get the money? You have to borrow money. Correct? That's the process. You borrow money, and from that money, you're going to buy shares. And once you buy today, you have shares with you. Later, you're going to sell the shares. You sell the shares. And when you sell the share, what you have? You'll get the money. That money, you use it for repayment of money. Hope you're able to get it. Of course, for borrowing to repayment, you'll have to pay some interest cost. We'll come to that. This is a simple structure, simple process. You borrow money, you buy shares later. This is today. This is later. You sell shares, and with the shares, you get money. That money, use it for repayment. So every position is closed. Again, you're back to zero position. You might make some profit in this process. I think long position is not a difficult thing. We are going to write a tabular format as well. Don't worry. The issue, the problem is always the mindset of short position. So I'll take this part out. I'll go to short position. Let me spend time on that. Don't worry about this. We are going to write a summary later that will cover this also. So let me talk about short position. Ultimately, what is short position? Sell later. Sorry, sell now, buy later. Okay. Now I'll explain simply how it happens on an intraday concept. Okay, on an intraday basis. Then I'll tell you how it will happen on a larger basis. Then we go for derivative as well. Don't write it down. I'll give time to write down. You see, in stock market, the transactions happens at 3 stages. Do you remember? One, you make an order, and then you will have a trading where the price should match, and then later the settlement will take place. That's a process, right? In transaction stock market. So let's say you are there, you, and there is a broker, Zero the Share Khan, Upstock, 5 Paisa, Alice Blue. You are there, broker is there, and then stock market is there. So 3 things. Okay, now for intraday base, I'm telling you, tell the stockbroker, make a sale order. You request, make a sale order. So broker will execute or will do a sell order. So you tell the broker, and broker will make a sell order. Now, when there is a sale order, what the process will happen or what transactions will take place? The broker will give money to you, right? You have right to receive money. You have right to receive money, and you have obligation to give shares. Obligation to give shares. Correct? That is, you have to get the money, you have to give shares. The broker will place the order. Now, let's say order gets traded. Now, in the evening, let's say sell order, you're selling at the order placed at executed at 100 rupees. This is happened in the morning. This happened in the morning. Okay. Now, in the evening, before the market closed, you know what you do? You tell the broker, sell that order. I mean, what you bought, now sorry, 1 second. In the morning, you told the broker to sell, the broker did it. So, in the evening, what should happen? The broker will give the money to you, you should give the shares to the broker. Correct? Now, what you do in the evening, before the market closes, you tell the broker, please buy for me. You tell the broker to place the order with the broker to buy the share. Same share. In stock market, you buy at that point in time. Let's say market price went down to 98 rupees. Okay. Now earlier, you have the obligation to give shares and right to receive money. What you have now? You are buying the same share. Buying the same share means you have obligation to pay money, right? Obligation to pay money, and you have right to receive the share. Right. You are buying the share. Right to receive shares. Right to receive shares. Now, eventually, please do what happens. Here, there was obligation to, in the morning, there was obligation to give share in the morning. Evening, there is right to receive shares. So, morning I have to give, evening I'll receive. I don't want to do it. I will cancel the agreement. Now, in the morning, I had right to receive money. How much? Right to receive money, 100 rupees. I sold at 100. And now in the evening, I have obligation to pay. What is the market price? At what price this trade took place? 98. Effectively, net basis, I'll receive 2 rupees. I received 2 rupees. But let me tell you, this is the whole process. You need not write it. I just told you for your knowledge purpose. In stock market, you know what do? We go to Zerodha, we log in, we select a stock and we say sell. At whatever price is there, it will be sold. In the evening or any time, 10 minutes later, 1 hour later, 3 hours later, I'll say that thing only and go and say buy. That order is closed. Just like I buy, then I click and sell. I click first to sell and then buy. It is allowed. Intraday basis, it is allowed. Now you know what we'll think. It is allowed. You can click sell order. I told you that's why. You see, settlement takes place later. You are making a sell order. Somebody else is doing a buy order. So try to think rather than actual physical movement, you just tell, that's what I told you, right? Here in the first case, you have an obligation to give shares. Settlement will take place later. So first what you did, I placed an order to sell. Other person placed a order to buy. Now cash did not actually transfer. Shares did not actually transfer. These are all just orders. I executed a sale order. Other person executed a buy order. In the evening, we'll square off our position. I close it. So in the morning I sell, evening I buy, my position is closed. I don't have to give shares, I don't have to receive shares. Because when I say, again, what you're thinking is, how can I sell without having? Please keep it in mind. I am telling I'm going to sell. See, just imagine this. Okay, you go to Kirana shop. You say, I want rice. He will tell you 1000 rupees. You pay him 1000 rupees. He may not give you the rice immediately. When will he give? He might do delivery, right? He might come to you in the evening and give it to you. Are you understanding? When you are buying the share from Kirana shop, he may not have the rice immediately with him. He will arrange somewhere and then give it to you. I hope you are getting the point. When you sell, you need not have with you. Anyway, so keeping it all aside, what you should think, in short position, I sell first, I buy later. It's perfectly allowed in intraday. Even though in your holding you don't have share, you can click sell button. It says minus 20 in your account. If you sold 20 stocks, it will show you minus 20. Means you don't have, but you have sold. By the evening, you have to do square off. The 20 should become 0. If you don't click plus 20, if you don't buy 20, it will be automatically squared off at 325 in intraday basis. Okay, sir. Intraday basis works beautifully. Just sell and buy. Within a day, it is closed. Now, is it possible to do beyond an intraday? In short position in India, it is not allowed. For retail people, for institutional people, it is allowed. That's called as stock lending mechanism. Let me explain that. Maybe that should give you a little bit more clarity. That you should write down. This is only for practical purpose, not required for exam. so that you leave it. This let's understand in detail now, that is short position mechanism, or this is called as stock lending mechanism. Stock lending mechanism. Okay, so what transactions you do today and what transactions you do later. Okay, now what is the first thing I told you? In short position today, what should I do? Today I have to sell, right? We have to sell shares. We have to sell shares. You have to sell shares. Now, coming to your question, you don't have shares where you can sell. How can you sell? I will tell you now. You borrow shares. You borrow shares. Sir, how to borrow shares? Agreement will be signed. I mean, practically, how is it possible? Yes, when you borrow gold, you borrow commodities in your childhood. If your pen is not working, you borrow pen from your friend. Before this money system, we had a barter system. We used to borrow commodities, borrow rice, borrow sugar, borrow commodities. Like that, you borrow shares. There will be agreement entered, for example, between institutional level. This will not happen at retail level. Individual people cannot happen. But at an institutional level, people do borrow shares from, let's say, HDFC Bank borrow shares from ICICI Bank. They enter into an agreement. Shares will be transferred to their name. Possible. Practically, individual people cannot do it, institutions can do it. For exam purpose, simple, you can borrow shares. So once you borrow shares, you are going to sell the shares. And once you sell the shares, you receive money, right, today? Once you sell the shares, you receive money. You receive money. Now, once you receive money, you will have money with you. You don't keep it idle. You will deposit. I'll say receive money and you deposit. Because the money keeping idle, you lose opportunity cost. You deposit of risk-free interest. So later, after 1 month or after 2 months or after 1 year, the deposit will mature. Deposit matures. Now deposit matures, so on this you earn interest income. You earn interest income. Now deposit matures. Now deposit matures, you have money now, but with that money you have to buy the shares. Why should you buy the shares? Because I had borrowed shares earlier. I have to give it to them. I need shares now. So I'm going to buy the shares. I have the money now. No, I can buy the shares. And let's say if it is sold at 100 rupees, if I'm buying at 98, I'll make a profit of 2 rupees. Or if I'm buying at 102, I make a loss of 2 rupees. So this difference, the buy price and sell price, is my profit or loss. Profit or loss. And once I buy the shares, I'm going to repay the shares. I'm going to repay the shares. And because what is the advantage for the person? Should I pay any interest here? No. Money, I pay interest. Borrow because time value of money. But earlier the person had shares. Now I'm giving back to him the shares. Earlier also shares only. Now also shares. See, if I take car back and if I take the car and give the car back, there's depreciation of car. Commodity value will not change. But shares value will decrease. I mean, shares value will not depreciate. So earlier what he had the shares, now also will have the same shares. But for these things, he will have some default risk, right? What if you don't give it back? Some risk is there, so there might be some charges to be paid. So here you'll have some charges charged by the borrower or some intermediary, commission brokerage. So charges will be there. But usually in exam, we assume no charges, so this will not be there. So ultimately what you have now, you had borrowed shares earlier and now it is repaid. That shares is closed out. Earlier you received money, now you have some money, the differential amount, I mean whatever net amount is your profit. So this is your complete short position. So take it down, and it's again same process for you to think. You borrow shares, you sell shares, that money, you receive money, you deposit matures, you will have that money use it for buying the shares, and the shares will be used for giving back to them. You repay some charges, interest income you get, profit or loss, you will have overall net profit or loss. By considering all these things, overall you may have profit or you may have loss. That's what is uh, shorting mechanism. So please write it down. Let me know if you have any doubt. Then I'm going to compare what exactly do in long, what exactly do in short. We'll do a quick summary. Okay, hope you have taken it down. Let me quickly give an idea about practically what are various forms of shorting. Let me quickly write down. Shorting forms practically. Shorting in practicals. In spot market, how can we do? In derivative segment, derivatives market. In spot market, we can do either intraday or positional, more than intraday, beyond intraday. Intraday allowed for retail also, allowed for retail also, and also you get margin. You can invest more than money what you have also here. Beyond intraday allowed only for institutions, allowed for institutions only, and that's what we mean by stock lending mechanism. Stock lending mechanism. Whereas derivative markets, you have futures. This is allowed for retail also. In derivative market, even retail people also can short. Allowed for retail also. Allowed for retail also. In future market, yes, you can do future sell. You can do future sell. In options market, you have two choices. In detail, discuss later, but you have two choices. One is you can become call option writer, or you can become put option holder. You become call option writer, or you become put option holder. You become put option holder. What is that and all, we'll discuss later. Just write down for your reference now. Okay, hope you have taken it down. One more small bonus point for you now. This is my point, not there in any textbook, not there in any exam purpose. It's for your pure practical application. My bonus point to you for your practical understanding. Can I use shorting for investor? Shorting for investors, long-term investor. Now for investors, can they use the shorting mechanism to reduce their costs? This is my opinion, my view. So not for exam purpose. Suppose you have purchased HDFC Bank, let's say at 1,600 rupees. HDFC Bank, 1,600 100 shares at 1,600. 100 share 1,600. So what will be your cost? 1,60,000. Now what will happen? Suppose the share is falling down. You are expecting further downfall. So what do? You sell the shares. You have the share in your account. You sell the shares. Let's say it has fallen to 1,580. You have sold. Again you buy the shares. Let's say share has fallen down to 1,500. Okay. Now you have the shares with you. You sold the shares and you bought the shares. Not now. Let's say 1 month later, 2 months later, whenever it is. Ultimately, you have 80 rupees profit. Means 80 into 100, 8,000. Now you could reduce your cost. So what is the net purchase price now for you? Net purchase price 1,52,000. Right? You could reduce your cost of investment. So if the share price falling down, you're expecting the share price to go further down, you can sell, and with further fall down, you buy. So you can reduce your cost of investment. I'm not sure whether you're able to get it. But if your things work out, at least I do it for myself. I don't do it for outsiders. I don't do it for my clients, but I do it for myself, this one. I hold some shares. If price falls, starts falling down, like what is happening now, I'm worrying. I sell the shares. Then later, if stocks reaches some bottom, I'll buy the shares. So I sold at higher price, bought at lower price, effective some profit I could make. So my original cost of investment I could reduce. Had I not done this, what would be my cost of investment, or what would be my value of investment? 100 shares into 1,500. So 1,50,000 would be my cost, right? Now I made my value of investment would have been only 1,50,000. Value would have gone down. I could make some profit. I could recover some of my loss. But anyway, this is practical thing. Don't worry too much. If you understand, also good. If you don't understand, also good. Let's back to the process. Let's try to understand. Okay, in this shorting process, there is one important thing that you have to understand. Very important thing. Please pay attention to this. Please pay attention to this. Let's say when you borrow the share, market price is 100. When you repay the share, market price became 98 rupees. Now the question is, should you compensate 2 rupee for the lender? Think from lender point of view. You have given the share, you are taking back the share. Charges and all you forget. You have given the share and taking back the share. Now you are incurring 2 rupee loss. The 2 rupee loss should the borrower compensate for you? The answer is no. Why should he compensate? Had you hold the share, you would have incurred that loss anyways. You are holding the share for 3 years or 3 months, whatever it is. So if you just hold the share without giving it on, without lending it, still you would have incurred that loss. So that loss will not be compensated. So mere decrease in the value of the share will not be compensated. But for something will be compensated. What? Dividend received. Think about dividend. Think about stock split. Think about bonus. Let's just think about dividend. I am giving the shares to you. Now you are the shareholder, right? You will receive dividend. Now, when you're giving the shares back to me, will I have the shares with me during this period? Am I the shareholder? I don't receive dividends. Because I given the share to you, I lost the opportunity of receiving dividends. I repeat once more. I am lending the shares to you. You give the shares back to me, let's say after 3 months. In those 3 months, if the dividend is paid out, if I was the shareholder, I would have received it. No, because I gave it to you, in the process of coming back, I lost the opportunity of receiving dividend, which need to be compensated. So, when you pay, you also have to pay, very importantly, the borrower should pay the lender dividend. You might not get dividend, but you have to pay the dividend amount to him because that is a compensation that the lender should be given. Let's write the sentence. Write the sentence. Write down. Dividend in shorting. Dividends in shorting. Dividend in shorting. Okay, write down. If dividend was paid, if dividend was paid during the period of borrowing, if dividend was paid, if dividend was paid during the period of borrowing, if dividend was paid during the period of borrowing, if dividend was paid during the period of borrowing, if dividend was paid during the period of borrowing, then the borrower should compensate the lender. Borrower should compensate the lender. Borrower should compensate the lender. Borrower should compensate the lender for the dividend amount. For the dividend amount. For the dividend amount. Because, 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 because if the lender, if the lender continued to be the investor or shareholder, because if the lender continued to be the shareholder, if he continued to be the shareholder without lending, if he continued to be the shareholder without lending, if he had continued to be the shareholder without lending, he would have received such dividend. He would have received such dividends. He would have received such dividend, which is which is which is denied, which is denied now, which is denied now because he is not the shareholder, which is denied now because he is not the shareholder, which is denied now which is denied now because he is not the shareholder, is not the shareholder. Okay, now let me give one simple process to you. Let me explain this, then you can take it down. Okay, let me explain this, then you take it down. First, you would listen. In long position, what happens? In short position, what happens? If they ask in exam, how are we going to represent it? In this one slide, I'm giving you the format, which is logical format, easy format, and this is what we are going to solve in problems. Listen to me first, then you can take it down. Long position. I am creating two assets, money, shares. In long position, I borrow money now. You've written this process already. You borrow money now. Using that money, you buy the shares. And later, that shares will be sold, and that money you get will be used for repaying the loan. Now, on shares, you are a shareholder, you will receive dividend. So, dividend is your inflow, and on borrowing you have to repay along with interest, that is your interest expense. So what is the overall profit? If I say sell price minus buy price plus dividend received minus interest paid, that is your, of course, transaction charges also can be subtracted, that is overall profit in long position. In short position, in money you borrow, money you deposit, shares you borrow and sell, you borrow and then sell. You borrow today and sell the share. Later, you buy and repay. And where do you get the money? The deposit will get matures. So, on the deposit, you get interest income. On when you borrow and sell, their dividend payment will happen. Why dividend payment will happen? We have just written the sentence as a compensation. So, overall profit is selling price minus buy price, dividend paid plus dividend received, I mean, interest received. Exact opposites. Here it was dividend received, interest paid. Here opposite, dividend paid plus interest received. Of course, subject to transaction charges. So, please make a note of this. This is the format we are going to solve in problems. On money, you will have a interest. On shares, you will have a dividend. I'm going to give you one more format for more conceptual clarity. First, you write down this. Let me know if you have any doubt. Okay. So, what and all should come to your mind? Long position, short position. Today, later. On money, what do I do? On shares, what do I do? Simple, this tabular format will make your life easier from exam point of view. Okay, hope it is done. Now I'm going to give you the format which you really like the most in the form of balance sheet, asset and liabilities. And hopefully this format should give you little bit more confidence in terms of clarity. Let me show you that. Don't write it down. I'll give time to write. You have a balance sheet. Now two things we are discussing: money, shares. Now I told you zero position. Balance sheet also beautiful zero position. Asset liability. Asset liabilities. You should know the balance sheet by now. Now in long position I borrow money. So liability is my borrowing in money. And with that money I buy shares. So that is my asset. One long position, short position. I can also say one asset, one liability. Now I have borrowing in money. So that is my interest expense. I have investment in shares. For shares, you will have dividend. Because you have assets, it is dividend income. I hope it makes sense. Now coming to short position, I borrow shares. Shares is my liability. Money I deposit. So money deposit means interest income. And shares I borrow. So dividend payment. Easy to remember, right? Asset liability. Asset is shares, dividend income. As a liability shares, dividend expense. Liability is money, interest expense. Asset is money, interest income. And why dividend payment will happen? Sentence you have written as a compensation. That logic is for understanding. Examination format. How quickly you can calculate. So write this format also. Hope this should give you a better clarity. Okay. I hope you are able to take down till here. I'll just repeat the process once more. Don't take it down. A kind of repetition. In long strategy process, what do? We borrow money. With that money, we buy shares. Then we hold the shares. Later, we sell the shares. We get money. We repay money. Our position is zero. In short strategy process, we borrow shares. Then we sell the shares. We get money. We deposit money. Deposit we get. Deposit money will get matured. Using that money, we buy the shares. That is going to be used for repayment of shares. Okay, so here when you repay money, you are going to have interest expense. When you repay shares, you're going to have a dividend payment. When you hold the shares to sell the shares, you might receive some dividend. This will be dividend income. And here, deposit money to buy the share. I mean, when you deposit money, you will have interest income. If you want, you can take a quick picture of this. Okay, you can note it down later maybe. This is again just a repetition. Again, once more repetition. Today, what do we do? Later, what do we do in long strategy? On shares, on money. Shares we purchase, money we borrow. First, we borrow, then we buy the shares. Later, the shares what we bought will be sold. Borrow money will be repaid. In short strategy, on shares we borrow, money will be deposited. Later, the money will be matured. The shares will be repaid. This is a tabular format. I explained to you already. It's a repetition. Okay. Ultimate summary of long position, short position. In long position, we buy first, sell later. In short position, you sell first, buy later. That is called as bullish. Taking a long position view means bullish view, expectation. Short position, bearish view. If the price goes up, long position, expectation come true, profit. In short position, expectation is opposite, you make loss. If the price comes down, long position did not like it, you make loss. Short position was expecting the price to come down, you make profit when the market price is down. Interest on money in long position is expense, in short position is income. Dividend on shares on long position is income, but in short position it is payment, it is expense. So please, you can take a picture of this maybe just for your reference, or you can copy it down as it is comfortable to you. Okay, so this completes the basic definition of derivatives. Hope you practice this, revise this, because this is the foundation. I'm not talked about derivative much. I just talk about terminology, long, short, zero position, net settlement, delivery settlement, speculation, arbitrage, hedging. I just talked about the basic terminologies. How we have to apply this. That is what we are going to see in the sessions on futures, options. All these things will come there. So make sure you revise these concepts as much as possible. Okay.